As the stock market scraped the sky, the air is getting a little rarefied, at least for nervous investors, but maybe to help you breathe a little more easily. Sean O'Hara is here now with stocks that carry strong dividend yields, and I still don't know why at Pacer Financial, though, that you guys aren't a little more concerned, or are you? You got to tell me your sentiment at this very moment. Listen, everybody loves a bull market run at this moment, especially if you're long. The shorts hate it, but get to it. What do you think?
Well, I think part of the issue is there's no place else to go. As the lead-in was saying, you got negative yields all over the world. There's some $10 trillion at negative yields. I think there's a little bit of uncertainty across the globe, although there are opportunities, and one of the names I gave you is in one of our funds, which is not a U.S. stock. But I think the flow of money here in the short run is into U.S. equities and into U.S. bonds as a safe haven. So it could continue for a while. We're long everything on our ETF family in the U.S., both large cap and mid cap. And we have a global dividend strategy, which is when we get to the individual names. All of those names come out of that, which is what I think makes sense given where we are, which is to start thinking about individual names, understanding what you own, and starting to develop a plan for what happens if the steam comes out of this engine.
Look, mutual fund investors pulled a net $67 billion out of equity funds last week, but then I saw that I think Thursday was the largest ever inflow into a corporate bond ETF. $1 billion. Okay, those are Sean's dividend winners. All right, we'll talk about that instead. But what do we have? We've got Rio Tinto, 6.75%. What worries me there, Sean, is that that's a stock that is down year over year. And Charlie Gasparino's here, and he brings up Kinder Morgan as an example, right?
Yeah, I mean, Sean, I guess the point is, and I know you know this because we've spoken about this, these dividend stocks are landmines, aren't they, in some respects?
Well, when we do dividends at Pacer at our ETF on the one that's a global dividend ETF, PGHD, we focus on free cash flow yield first and then dividends. So Rio Tinto is a great story. It's our #1 holding. It replaces the #1 holding from the last 6 months ago, which was Glencore, which everybody thought was a disaster as well. We had Glencore come into the portfolio for the very same reasons that Rio Tinto is. The stock had gotten hit a little bit. They have free cash flow. Their dividend yield was high. And in the 6 months we owed Glencore, it was up 60%. Rio Tinto, since we own it, is up about 10%. So nice. I think free cash flow yield is the driver. So you think, Charlie, you and I were talking in the green room about people chasing dividends. That's why we start with free cash flow yield. You have to be able to pay the dividend with something. And the real danger in the dividend market is that there's a lot of companies and a lot of people chasing dividends where the company doesn't generate enough free cash flow.
Which is what Hedgeye had pointed out a while back.
What do you think of KMI? I mean, Kinder Morgan, it's very controversial stock. You know, Bob Kinder is kind of a legend on Wall Street. You know, he's been around for a while. Don't you?
But they had a very high dividend. They
had a huge dividend, and then that report came out in Hedgeye. People poo-hooed it, and now it looks like he was kind of like right. Do they have the cash to pay off their dividend?
That's the big challenge in all of the energy sector. My partner, Joe Thompson, loves Kinder. He loves energy. We're looking at some energy ideas right now. But energy is, at least a certain segment of the energy market, is very dependent upon oil prices. So if you could tell me where oil prices were going, then I could tell you more definitively what I think about Kinder Morgan.